Okay, the questions that is on everyone's lips all the time is, when are rates going to come down? Is the sky going to fall? What's happening? Should I sit around and wait for a foreclosure and snatch up a big deal? I'm interviewing the fabulous Elly Cummings. She is one of the smartest gals in the mortgage business as far as I'm concerned. And she's going to answer all these questions. So let's dive in.
You're listening to the Girl Get Your Face Off a Bus Bench podcast, where we invite you to check your ego at the app, grab a cup of coffee, and get ready to dive into all things real estate marketing, social media, friendship, hardship, love, money mindset, and all the things that celebrate you as a badass boss babe.
We're here to encourage you, show up for you, give you a loving kick in the pants when you need it most, and be your soft place to land on the hardest of days. So pull up a seat at our table and get ready to be inspired and start living your best life by design.
Welcome to the Girl Get Your Face Off a Bus Bench podcast. We are so excited you're here.
Okay, girls, let's dive in. Okay, Bus Bench babes, we have a special guest today. We have Elly Cummings. She is the Executive Vice President of New American Funding, and we had her on the show before. She and I have known each other for years. We go back like 20 years. We met through a friend of a friend. And if you are inspired by this episode, you're probably going to want to go back and check out episode 80, where she dished all the good stuff then too. So welcome to the show, Elly. I'm so excited that you're here. You're a busy gal, and I always feel honored when we have you on the show.
Thank you. I'm excited to be here this morning.
Yay. Well, so introduce yourself. Tell us a little bit about yourself and
all right.
All the things.
Okay, well, this morning I happen to be coming to you from not so sunny Florida as I look outside and watch the storm roll in. But I split time between Minnesota and Florida. We're going to talk all things mortgage because that is what I've been doing with most of my time for the last 25 years. Yikes. I go, I'm not old enough to say I've been doing something for 20 years. Just kidding. Apparently I am.
When you're not doing mortgages, what do you love to do for fun?
Water, whether I'm on the water, in the water, by the water. So Minnesota, summer, lakes, favorite thing in the world about Minnesota. And down here, I can see the water from where I'm sitting. I'm not actually on it. I can see it, which helps. And so, yeah, travel, being by the water when I'm home, anywhere, and then travel would be I feel like that's my biggest passion. If I'm not working and talking mortgages, I'm hopefully on an airplane and traveling somewhere.
Amen to that. That's how I feel. I like to live my life too.
Yes. And you just got back.
Your kindred spirits in that. Yeah, I went to Hawaii for my birthday week last week. It was great. It was perfect time to unplug and hung out with my favorite aunt, and it was perfect. Just what I needed.
Cheers to that, and happy belated birthday.
Why, thank you. Thank you. Thank you. Well, so the burning question of the hour that everybody wants to know, and I thought, why not just go to the source of all things knowledge and real estate and mortgages? We have buyers sitting on the fence that are like, well, we're just going to wait for the sky to fall and the market to crash. What's your take on all this? I would love to know.
That's not going to happen. And that is such a tough mindset that we are work every day to try to get people out of. This market is so unlike previous markets. We've got, as you well know, we have a shortage of inventory and rates are high. And when we look at them overall, I go, they're not actually high. They're pretty normal, but fortunately / unfortunately, we're coming off this record low rate environment that wasn't sustainable. So people think they're high when they're truly what a normal market would bear. And it feels like a lot are getting over the sticker shock of that, but there's still plenty, to your point, that think, oh, I should just wait and rates will drop and then everything will be great. And I'm going, well, it's kind of like reverse engineer that. If you wait for rates to drop, everybody who's sitting on the sidelines is going to flood the market. There's not going to be any more inventory. It's not like home builders can pop up, 500,000 homes between now and next summer for everybody to to buy that aren't already pre-sold or, like engaged somehow. And I don't know, the strategy that I think is a far better play in this market is to buy now and refinance later. Rates are transitory, and most people are going to refinance their mortgage 2, 3, even 4 times while they live in their house because the markets do go up and down. So it is not a good time to sit on the sidelines. I think we're going to see prices driven up even higher next year. I don't know, like I'm on a tangent, but if you look at the forecast from the beginning of this year on home prices, like every legitimate source talked about home prices being flat or falling slightly, and they've all adjusted their forecasts and have them up anywhere from 6 to 9%. And it's just going to go up next year.
Every one of them has changed it. Yep. Everyone changed their
tune. This isn't me in my crystal ball. This is like the smartest people in economics and real estate at Case-Shiller and CoreLogic and everywhere. Freddie Mac, Fannie, the MBA. It's like home prices are not dropping. And next year, we're just going to see them up even more. So I don't know. This is super interesting. We did a graphic last week on it. If you bought a house today using a 7% interest rate, and let's say you did a $400,000 mortgage and bought the house for $500,000, your payment would be like $5 less than if you did it next year when you had to pay $50,000 more for the house and had a 6% rate. So there's real logic behind now still being the right time, because even though you could get a lower rate, if you're paying more for it, you're not getting a better deal.
You're not getting ahead.
So get off the sidelines.
And then you can always refinance.
Exactly.
I know. That's what we're screaming over here too. And it is a really big and it's a really legitimate objection that we are overcoming or trying to overcome on a daily basis.
Sure. And
is getting people to see that logic.
And it's fear. I think there's a lot of fear and uncertainty, and it is people get their information typically from the news, and the news needs ratings. So they want to tell exciting stories, make things sound worse than they are, or, just create a buzz about something. And it can certainly get people feeling more uncomfortable when they should be looking at this like we are in a great market to buy, and you only have upside from here.
That's what I think too. I love it. I love that we're on the same page about that. Are you seeing any similarities from the market that we're currently in to back like 07, 08 when we all lived through that
nightmare? And I think we all have PTSD of that nightmare. But when you look at it, we had like double the inventory of homes, like more than that, like way more homes available and far less families being started. So now, like, you take two different things that are very impactful in the economy. We have a fraction of the homes available, and we have more household formations, meaning we need more homes just from, not because people want to buy, because people are aging up and creating households and they need to have shelter. And we didn't have that disparity back then. We had more homes being built, more homes in inventory than we had ever had. We had months of supply. Now we are short on all things and are creating more households. So I think we could not be looking at two more opposite markets when it comes to what's going to happen in the near term. Now, there's similarities around recession and inflationary behaviors, but there are like zero similarities in how those are going to affect housing.
Are you guys seeing anything on your end with foreclosures ticking up at all?
No, but I think it's really interesting to point out. I'm going to say no because I'm going to compare this to a real market and not before there was a stay on foreclosures due to COVID. So a couple of, maybe it was 2-3 weeks ago, it was all over the headlines that mortgage delinquencies have started increasing. Well, of course they're increasing because for almost 2.5 years they were at zero because people couldn't foreclose. So if you look back to pre-COVID to 2019, we will still probably annualize out at a foreclosure rate less than we were at in 2019, which for all accounts was considered a stable market. And same if you go 2017, 2018, 2019 and look at all of them, it's that same area. So we are there's a technicality that makes it reportable to say that foreclosures are on the rise, but anything above zero is on the rise. And we're looking at a market where maybe we're going to see 2.5%, which is considered average.
Okay, that's super encouraging. Rates many times come down in an election year. Like, what are your thoughts on that? And what is your crystal ball going to tell us?
I mean, I wish that it was going to tell me and everybody in the world that we're going to see them significantly lower by year end. The reality is, I think we're probably not going to see real movement for about a year. And there's a lot of just following data trends around this. There's a lot of reasoning behind it with what the Fed has been doing. Now, there are a lot of forecasts that show rates coming down slightly in the fourth quarter, but I'm going to preface that with slightly, like an 1/8%, maybe a quarter. But there's still so much. I don't know. We're in a bit of a conundrum, for lack of a better term, of where we still see solid jobs numbers. And the Fed's kind of a one-trick pony when it comes to how they look at inflation. They're looking at jobs and they're looking at like CPI and PCE. What they're not really looking at is the fact that we've now amassed over $1 trillion in credit card debt, and that the average consumer is at a negative savings rate. And now we have student loans going into repayment. So we have these households that are spending money on Amazon because it's convenient and on retail, and they're still buying gas because of course they need to get places, but they're doing it on credit cards. So all of this money that's continuing to be pumped in isn't because people have it. So it's gonna, so what they're looking at isn't like total big picture, but that's our short-term issue. They're going to be measuring these almost archaic markers that always have a huge lag time to them, which is just kind of supporting that it's going to be higher for longer. And when I say higher, I think we're about at a ceiling of where rates are going to be, but coming down, it's always, I don't know, if rates go up like a rocket, down like a feather. So it's going to take some time on that. I think that we'll see like little increments of, we might get an 1/8 to a quarter in the fourth quarter. You might see another 1/8 to a quarter between the first half of the year, but it really feels like it's going to be like third quarter 2024 before we would realistically see rates be able to get in that sub 6% range. But there is a reality that those rates will come back because of this whole Fed cycle. The Fed still controls monetary policy, and they're going to hold right now to figure out what's happening with inflation. And once it gets to their measure, start dropping and do their quantitative easing. And when it does, I don't know, in my opinion, they usually overcorrect just like they did in COVID. So that's when you see the rates come down significantly, but then we just kind of start their cycle all over again. But
I am a person that likes a little bit more predictability in my life, and the cycles stress me out.
They are stressful
because and
it's like you're on pins and needles because you look at things and you're like, okay, well, you can see it. You know that when you go to the grocery store that milk is still expensive and that eggs are more expensive than they were 3 years ago. And I think the logic in us will say, once certain things hit a certain price point, they usually don't come back down. Like, I don't know that like McDonald's has ever reduced the cost of a cheeseburger after an inflationary cycle. It's just, over time, everything just gets incrementally more expensive. So we're sitting here looking at all of these things, and we're just gonna wait for the Fed to tell us everything's okay. But there is a new reality to everything of things are going to be quote unquote okay, and we're going to see certain things become cheaper and the cost of money become cheaper, but we're not, and gas can come down, but we're not going to see life get significantly cheaper after that. So there's just a lot that goes into this. There's still a lot of opportunity. I go back to, I don't want to sound gloom and doom when I say certain things won't get cheaper, but that's where like having a holistic portfolio of what's earning money for you, like real estate versus investments, is huge in that, because you will have, because things are more expensive, equity grows at a higher pace, and you have more equity and you have more money you can use to invest or to build up generational wealth in a future, even though we're entering a world where things are more expensive. But it was the same for us when we were young. It's not like we had 5-cent cheeseburgers that we could buy at McDonald's. That was 40 years before our time. And, now it's no longer dollar cheeseburgers, it's $2 cheeseburgers. But you hope that wage inflation goes along with that. And real estate is also appreciating at a level that far surpasses inflation. So that goes back to why it remains such a solid investment, even above like overall traditional investment vehicles like your stock portfolios and IRAs.
It's like so much. It always like just hurts my brain, but that's why I love talking to you about it, because you like make it real, you make it bite-sized and easy to digest. I appreciate that about you. The market feels funky. What is like something that's surprising you about this current market that we're in?
I feel like I'm somewhat surprised every single day. There's no doubt right now that there's a certain price point which is we need that we're not finding anywhere because of inventory. And like when you go into kind of funky, I think a lot of people are sitting there not sure what to do because they should move up, they want to move up, but they go, man, I have a 3.5% interest rate on this current house, I should just wait. And it's like, okay, but you have a family of 4 living in a 2-bedroom, 1-bath house. Do you really want to wait? What is the impact of 7%? And using different strategies to get them over, I think is key. But back to what I think is more interesting about markets that we would never typically see is we've got some potential gloom and doom about a pending recession. And it's like, but it's not the world's not going to fall apart. But yet we have in markets, we have home prices increasing at rates that are not at all indicative of any type of recession. So you've got like the total opposite of what logic would tell you happening with that right now. And coming up with creative strategies, that's kind of where I think funky is key here, of using buy downs, using different ways to get people comfortable and giving up that low rate, because if you've outgrown your house, what good is a low rate to you? Like it was great to have it, but I don't know, it's also kind of weird I think we've talked about this before, but if you went back 20 years ago, people didn't talk about their interest rates at cocktail parties. And once the market went gangbusters and the rates got so low, it became like everybody was just like, hey, what's your rate? I just got 3%. Oh, I got 2.99. And I'm like, it's so bizarre to me because, do you walk up to someone and be like, hey, the balance in my checking account is XYZ? I'm like, we've created this environment where it's almost like bragging rights over these low interest rates. And it is like, what's more important is what's your big situation? What's your overall? It doesn't matter if your rate on your mortgage is 3%, but you've got $50,000 in credit cards at 24%. Like looking at the big picture is so much more impactful than just that. Or I have a house that doesn't suit my family, but I can say I have a 3% rate. Well, if you can afford the payment at 7% and it suits your family better and you can grow into it, give up the 3%.
I love that. But like the analogy that you just gave of like, oh yeah, you're sitting on a low interest rate and then you're just maxed out on charge cards at ridiculous interest rates. Nobody's really having that conversation about like, that doesn't even make sense.
No, and people still think, like, I hear so many people say right now well, there's no refinances. People aren't refinancing. Why would you refinance? And through the second quarter of this year, 20% of all mortgages written were refinances. So people are still refinancing. And when you look at it from like a cash flow perspective, like just talking about dollars in and dollars out into your monthly budget, rates don't matter. Cash matters. Real dollars matter when you're looking at it from that perspective. So if you are paying $2,000 a month in credit card payments and you could increase your mortgage payment by $500, you're net $1,500 to the positive. You got to stop thinking about the fact that you went from a 3% or 4% rate to a 7% rate and think about the fact that you're saving $1,500. And like with the other thing that isn't talked about is with rates going up, it's not just on mortgages. Like think of like car loans and car leases a handful of years ago were at 0% at every single dealership. And credit cards were 12 to 14% and personal loans were under 6%. Now, I mean, you've got a prime rate that's over 8 and credit cards at 24 and car loans that are, people are lucky if they can get a 6% car loan right now. So we just don't talk about rates and how they affected everything else. We spend so much time talking about them on mortgages. And that's where I think refinances and debt consolidation remains very relevant for people because they are sitting on a ton of equity, like more equity than we have ever seen.
Mm-hmm. How I'm feeling the prime rate affecting my life is on my second mortgage that I use to flip properties. Right. Is that, a year and a half ago, it was basically like free money. The bank was just like, here's $100,000 to do whatever you want with. And it was going to cost you like $250 a month. Well, now that same thing is like triple that. And so that becomes a real bottom line cost when I'm crunching all the numbers on my flips. I'm like, that's making a humongous difference to how much money I'm going to get out of my projects.
Absolutely. Those are real life situations that are out there every day it's less talked about because we're so stuck on this headline of first mortgage rates are not 3% anymore.
Mm-hmm. The other conversation that I've had with people is they're like, well, I just, I feel like I lost out and I didn't get a 3% interest rate. And I said, look in like the most recent history that we've had. When interest rates crashed, it's because the Twin Towers fell and our country was invaded and we had a global pandemic. We don't want something like that to happen again in order for interest rates to crash. I said, so we got to find this balance, this middle ground where people feel like it's affordable to move on to their next place, but the world isn't also imploding at the same time because that's also not good. We don't want that to happen. And I'm like, I hope to God in my lifetime, I never see 3% interest rates again, if it means that we have to live through one of those experiences.
Like a catastrophic event. And that's what those big drops always come on. They come on the heels of something horrible. And we don't need to cripple an economy yet again, because that's really what the predecessor is to the low rates, is a crippled economy. And then you have to have these low rates to fix it. And who wants that? And go back, as I was mentioning, average rates, and 7 really isn't so bad. If you go back, and Freddie Mac had put out some data, and this was it was like 40 years essentially of data. The average interest rate over a 40-year time span is 7 3/4. That accounts for the times in the 80s where rates were 16, 17, 18%, and it accounts for post-pandemic when we were at 3%. But 7 3/4 is the average rate over 40 years, and we're still below that. Mm-hmm. And think about it too, like if you were lending your own personal money to someone for 30 years, would you only want to make a 3% return on it? Probably not. Like when we look at real estate, you're looking at the compound effects of how much you're going to get. When you sit down with a financial advisor and you look at like your adjusted average of what your portfolio should return, nobody's pitching you on something that's going to return 3%. You're hoping to get 10 plus over time as it averages out. So it's just different perspectives of how to look at it, of these, like, it's not realistic in any type of world that's working that you should expect someone to borrow you money for 30 years at a 3% rate.
Yeah. I like you're spinning this in different ways that like I hadn't even thought about. Like I'm loving this. Okay. So you touched on what you think rates are going to do, like going into 2024. What about beyond? Like, what do you see beyond like mid next year?
I think that we will find a bit of a floor and hold for the foreseeable future around that, assuming we don't have these catastrophic events come through. So if you look at when we started the end. So coming off of the crash, they did that whole quantitative easing, dropped the overnight Fed rate to like zero for the forever. And when they started bringing that back up in like, it was really like 2016, rates were up and we weren't like, the rates were not as low as they are now, but rates got up and they hung out in the mid fives, and they hung out in that range, and that we'll call it 5.25 to 5.75 right up until the pandemic, essentially. So you find like this area of averages where you have almost hit the floor until the next shoe drops, so to speak. So when we do find that lower floor, we're not going to sit on the floor, but let's just say for argument's sake that we're going to see rates in the mid fives. Once you hit that, barring again no catastrophes, they should be fairly stabilized within like a 0.75 point swing of that for the next several years ahead until the next cycle of something would come in. But usually the next cycle doesn't create a big swing one way or another. It might just be, we're up 0.25, we're down 0.25. So I think the reality is you're going to see rates over time stabilize between 5.5 and 6.25.
That feels really comfortable to me. And like that feels, I don't know, like those numbers sit well with me. And I feel like it's still affordable for somebody to buy a home and to move up and to do all the things that they want to do and not feel like their finances are totally being pinched.
I agree.
Yeah. Okay, so your number that you mentioned earlier in this episode where you said 20% of the loan applications were refinances, frankly, that number shocks me, and it's awesome. But that's probably considerably less than what all of your loan officers have been experiencing the last few years. So how are you keeping them motivated?
So I would say let's talk just kind of like as an industry, because we had we'll go 2020, 2021, when we surpassed like 4 trillion in mortgage originations, which is like double what it had been at the high point previously. Mm-hmm. You saw like some companies and some originators were like 80% refinances, 20% purchase. Mm-hmm. The group on my team, they thankfully have always remained very purchase focused. And even when the refis were falling from the sky, our concentration in our group was still 70% purchase, 30% refi. So yes, there's a loss there, but the silver lining for them, because they did not take the focus off of their purchase business and their referral partnerships during that time frame, was that they didn't feel the absolute, fall from grace of like the floor coming out from underneath them. Now it's still a loss of business, and purchase is down, just because of the inventory side of it. Mm-hmm. But we spend like weekly the time when it comes to motivating on talking about perspective and the different realities and looking at these strategies on like debt consolidation. It's changing the narrative and having conversations with people that are different, that aren't focused on rate, that are focused on payment, that are focused on improving their situation overall. And it even opens the doors for the consumer, because a lot of people just kind of get used to what their outflow is. And they're like, well, yeah, we've got to pay this to the credit cards, and my car payments are $800, not $400. And we're just going to kind of go through it. And they don't think about refinancing because they like their rate. So it's almost like it's a reason to get on the phone and call past clients and talk through and just check in with them and, do a temperature check of how are you. So we do a lot of like kind of role playing and scripting and encouraging around how to just have conversations. And it's not, they're their advisor. So you're not calling them to sell them on anything. You're calling to check in and see how they're doing and see what's changed in their scenario to see if something might make sense for them. So we talk about that. Mm-hmm. We spend a lot of time on like rate protection pledges and how we offer that on our purchase clients. Of any time the rates will go down in the next 5 years, we're going to give you a refinance without any lender fees and cover your appraisal. And we're not putting a cap on it, because we want to make it as affordable as possible and get people in a headspace too of thinking it's not bad to refinance. We also spend a lot of time talking about strategies using buy downs, because that really does help, because we all feel like rates are going to be coming down in the next year. So a temporary buy down versus a permanent buy down is a great tool right now. I personally try to talk people out of permanently buying down rates in this market, just because you're putting a lot of money at something that you might not get the benefit of, because the reality is if you're paying 2 or 3 points by choice to buy something down, it might take you 6 or 7 years to just recover the money that you dished out up front. And when we think rates are going to drop in the next year, looking at a temporary strategy really makes sense to like just have your mind open to what is going to be the best solution.
I've thought the same exact thing. I'm like, don't shell out all this money up front if you can refinance next year anyways. That does not make sense. That's why I love the 2-1 buy down.
1-1 buy down right now, for sure. It's like
putting yourself into an ARM or something like that. Like there's so many other ways to accomplish getting a lower interest rate that you can then refinance next year.
But so much of it is mindset, and like with our originators too, and just keeping people, it's a different market, and it is just having to like reframe and take perspective and take stock in what's going on. But it goes to not that I'm a motivational speaker and this is a motivational podcast, but it is like, you can look at something and go, what could go wrong? Or you can look at it and go, what could go right? And you've got to focus on what could go right. And also it is like with anything good that comes in our lives, it all comes out of hard work and repetition and doing the same things till we get the right results. And so we have a lot of those conversations too about you can't give up. It is harder. And yes, you're going to get 10 more no's than you did on everything in a normal market, but you're not going to hear the yes until you get through the 10 no's. So keep going.
Yeah. Totally a numbers game. I think people would fail to recognize that. Yeah. It's like you have to know your numbers. If you don't know your numbers, then you're like, I'm on call 8 today and I've had 8 rejections. Well, your numbers tell us that it's 10 calls for every conversion. So get on the phone and make 2 more calls. Someone's going to convert.
You've got the same thing in real estate. I mean, like, it doesn't matter what we're doing. We all have that. And it's like, think of the funnel. You just need to put more in the top of the funnel to get something out of it. And you can't stop until you've done the work. Yeah.
Everyone's gotten so lazy because we didn't have to work that hard the last few years. Right? And so now getting back to the basics feels like torture. And it's like, no, this is just normal.
This is reality.
This is like a normal market now.
Yep.
This is our job sales. Here, people.
We have to, there's objections. There's people that say no. We have to work through it. We have to, pull ourselves up by our bootstraps and keep going.
Oh my gosh. Yeah. And then I'm just managing a little team. You're managing tons of people. So I can imagine you're probably like, all right, get my pom-poms ready. Like, come on, kids, we can do this.
Keep going.
What are 3 things you want everyone to know about what we can expect for the 2024 market?
So I'm going to kind of go back to full circle to part of the very first topic we had is now is a good time to buy. Waiting is only going to make things more expensive. So I think that is key to think of going into 2024. The next thing, if you are expecting to pick up some fire sale deal because of foreclosures, I think that you are off your rocker. It is, we could all, when I say you could hope for a deal, we don't want a market where there's fire sale deals because of foreclosures, because that's a terrible market. And that means all of our home values are going down. But there are not, I don't think there's going to be any great deals to be had. So waiting for these defaults or distressed sales, I don't think is a good strategy, and I don't think it's a reality. And the last third thing, I guess I could keep going on this, but would be that always remember that rates are transitory, and I know it's becoming cliche of you marry the house and date the rate, but it is so true. We don't go into something because of the rate. You shouldn't go into something because of the rate. You need shelter, you need investments. There's other reasons for that. So getting beyond that mindset of what the rate needs to be, because the rate can always change. You can make the rate change through a refinance. Don't wait for that to be your driver.
I love that. Well, where can people find you,
So
Elly?
you can find me at Elly Cummings on Instagram, LinkedIn. I got a Facebook, but I'm not good at Facebook. But you can, I think it's just at Elly Cummings too, on all of those. And then follow our New American Funding pages. We all post content of mine too. It's NAF GLFL, Great Lakes, Florida.
Yeah, you guys do a really good job with your you do a great job with your personal social, but NAF also does a great job putting out super awesome educational stuff. I love following their page too.
Thank you. We put a lot into it, and I'd be a liar if I said that my personal was all by me, because I have a lot of help behind the scenes on that too.
Hey, it takes a
Absolutely.
village. It's got the same thing going on over here too. I'm like, I couldn't be doing anything that I'm doing without, Christy behind the scenes, like being the creative genius for
Thank
us.
God for them. I'm like, Rachel, can I put this out there? What do I say about this? And more times than not, she's like, I'll just handle it for you. Send me the pictures.
Send me your video and I will make all the rest of the magic
I can
happen.
edit it and whatever, so you don't have to get all frustrated.
I love that. Well, Bus Bench Babes, I hope you got some awesome tidbits that if you're a consumer listening to this, you're feeling inspired. If you're a realtor or mortgage person listening to this episode, you got some great nuggets and some really good, strong talking points to overcome those objections that you're getting out there in your day-to-day world. And Elly's always a pleasure to have on the show. So until next time, Bus Bench Babes, keep your face off a bus bench and keep being the badass boss babes that you are.
Okay, girls, are you feeling as inspired as we are? We're over here cheering you on because you just finished another episode of the Girl, Get Your Face Off a Bus Bench podcast.
If you want more, head over to girlgetyourfaceoffabusbench.com for show notes and more episodes. And don't forget to subscribe and leave us a 5-star review. They mean the world to us, and they're what keep us going.
Girl, thanks for being here.